In this video, we are going to see what Mohnish Pabrai thinks of the current market environment. We are at the end of 2025 and he just released an interview from Pabrai Wagons Fund. Every couple of months, you have a quarterly update and this is the latest one and they just published it on YouTube. So this is the replay of this. If you want to access this replay, you have very few views, very few people doing the work, less than 3,000 people, and every time they publish, it's a gold mine of information. Okay, so what we are going to do today is I will put play to this video, we will react to it, and I will add some comments because I sometimes buy what Mohnish Pabrai bought, including coal plays. And I have this in my portfolio right now. So I'm really curious to see what he is saying right now. I see you have a couple of timestamps here, including metallurgical coal companies. So it will be very interesting. And if you are following Mohnish Pabrai, he's a great investor, great source of ideas, and I think it's very much worth a follow. Okay, I think we can start. In case this is your first video from this channel, welcome. My name is Christophe. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And the goal with this YouTube channel is to help you become a better investor by looking at the great investors and cloning them. So let's clone Mohnish Pabrai today and see what he has to say. Normally, you should hear properly, and let's start. Okay.
Good afternoon. And welcome to the Pabrai Wagons Fund shareholder call. Before I begin, Aidan Townsend, our manager of investor relations, has a few disclosures and updates that he needs to share with all of you, and then I'll be back.
Thank you, Mohnish. Good afternoon, and welcome again to the Pabrai Wagons Fund investor call. Before we begin, let us start with the usual disclosures.
Okay, let me skip the disclosures. I was invited to come to the call and ask questions, but I didn't get the time. In case you want to ask questions directly to Mohnish Pabrai, you can just go to their website and register, and maybe you'll get a Zoom link to ask a question to Mohnish Pabrai. All right.
Back with all of you after a quarter. We got a large number of questions submitted to us before the call, some very high quality questions. And as I've done in past calls, what I've done is I've organized them first by holdings and then kind of general questions. And what I'll attempt to do is go through one question for each holding and then try to get to one kind of general question and then cycle back to, again, the second question on the same holding and so on. We also have the ability for you to submit questions online, but I have a large number of questions already here, so I'm not sure if I'll be able to get to. I don't even think I'll be able to get through the list I have with me, but I'll try to go as fast as I can while trying to provide all the salient info and take it from there. So it's great to have this august group of investors who are very knowledgeable about our investments and have asked some great questions. I'll start the first question, which is on our largest position, which is Edelweiss Financial Services in India. And the question is Edelweiss primarily value unlocking special situation for you via EAAA and other subsidiaries, or a long-term compounder you intend to hold for many years? Edelweiss currently has a market cap of about 1.15 billion, around there.
Let me just give you a quick glimpse of the holdings they have, right? So you understand the situation. This is what they have. This is what they own. And if you don't like this format, I believe you can look at the summary prospectus. Maybe they will share their holdings. No, I'm looking for a slide deck. Anyway, latest investor presentation from December 2025. So this is updated. This is their slide desk and you have their holdings here. So their first holding is a financial company in India, 20% of their portfolio, TAV Airports, and then coal, Homebuilders, car dealership, special drilling operation, and a rate in Turkey. Okay, Transocean, Valaris, all these offshore drilling operations are very tricky to analyze, and they were recently added to the portfolio. So these were the holdings, and he just said they would go questions by questions depending on these holdings. Anyway, let's continue.
They have planned an IPO of one of their 100% owned subsidiaries to take place in the April 2026 timeframe, like 4 or 5 months from now. And EAAA is a fantastic business. It's an alternative fund management company, kind of like India's version of Blackstone or Brookfield and so on. And the expectation is that the market cap of EAAA, when it's trading on its own, may be somewhere between 1 and 2 billion. We don't know where it'll end up, but probably in that range. And so if you think about Edelweiss themselves with a market cap of about 1.1 billion, which has a number of other businesses besides EAAA inside it, we think it's kind of just ridiculously undervalued business, because we saw the same thing happen when they IPO'd Nuvama, which now has a multi-billion market cap. And again, Edelweiss was under a billion market cap, and that was rolled out. And Edelweiss will probably be doing these IPOs for the next 5 or 6 years with the next 5 to 7 subsidiaries. Each of them could be 500 to $1.5 billion type market caps as they come out with varying degrees of ownership by Edelweiss. So we like a lot of these businesses that they are spinning out. And our intent at this time would be to hang on to these businesses. We like these businesses. And so as long as the businesses stay great businesses and the valuations don't get completely egregious, we'd like to hang on to all of them. Going on to the next question, which is on Turkey. How do you price currency and governance risk in Turkey for long-term holdings like TAV and Reysas? Let me just...
It's very, very funny. I've been following Mohnish Pabrai for more than 10 years now. And I was following him when he mentioned Turkey during COVID, saying nobody wanted to touch COVID, but I'm the only Indian guy who's willing to invest in Turkey, because nobody wants to go there, to go to the maximum inflation country that is not sexy whatsoever. Currency devaluation. You have plenty of tailwinds for specific stocks and plenty of headwinds for most companies. The goal is to differentiate whether a Turkish company will have tailwinds or headwinds depending on the currency. And this is also why Mohnish Pabrai invested in Turkey. He has spotted companies where the currency devaluation was and still is a tailwind, is helping companies, because I don't know, for a rate for Reysas, all the costs are in lira, so the Turkish currency, so all the costs are depreciating with time and devaluating, but all the revenues are in euro or in dollar, which means your income is not getting devaluated, but your costs are getting devaluated by the currency. So you have an arbitrage play. Your revenue, your top line, bottom line is fine, and all your costs are getting down and down and down and down. Okay, so pretty interesting situation here, very rare, and you have to be very focused to find these operations, find these businesses. Well, Mohnish Pabrai has found them. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video.
Take the governance issue first. So when we look at a business like TAV Airports, they are 44% owned by ADP, Airport de Paris, which is traded in France, and it's significantly owned by the French government. And I think ADP has board representation, and I think is exceptional steward of our capital on the board. Even the non-ADP board members are exceptional. With TAV Airports, we really have no concerns of any kind on the governance or management front. We think the leadership is exceptional. We think the board is exceptional. We think it's very shareholder oriented. So we don't see any issues there. Reysas is family-owned business where the principals have a large stake. Collectively, between the Wagons Fund and our private funds, we have a large stake. And we've been shareholders and, kind of learning about Reysas for about more than 6 years now. And
Yep. I remember vividly when they first mentioned Reysas a couple of years ago, and it's a father and son, and they've been working together, beautiful capital allocators, amazing shareholder friendliness over there. And Mohnish Pabrai took interest. I mean, he bought out more than 30% of the company. And at some point, Mohnish Pabrai sensed that the management team was uncomfortable having an outside investor having such a large stake. So Mohnish Pabrai stopped buying more, and so far so good. I mean, if you look at the stock price of Reysas, it's been on a run. It's been on a run. Look at this. Prepare your eyes. Here you are. He invested in 2020, I believe. He bought more in 2021, bought more in 2022. And since then, it's a 30x. He multiplied his investment by 30. He has beaten everybody. Even if you account for the devaluation of the currency, it is still a very, very, very good performance. Okay, so pretty impressive to have found Reysas. And I remember everybody was scared to touch Reysas at the time when Mohnish Pabrai pitched it during COVID. Anyway, let us continue.
We have not seen any issues which give us concern on the governance side. I think it is run for the benefit of shareholders, for maximization of shareholder value. We have seen tremendous appreciation of our position over the years. And we think that the value creation at Reysas is truly exceptional as far out as I can see. So in both cases, we have no governance issues. When you talk about the currency issues, in terms of TAV airports, a lot of their revenue is coming from outside Turkey, but even the revenue inside Turkey is contractually obligated for the most part to be paid in euros. So the passenger fees, security fees, etc., are all coming to them in euros. And in fact, they are generally a beneficiary of currency devaluations. They've historically gotten a tailwind from it.
Exactly what I said.
In the case of Reysas, some of their leases are priced in euros, but even the ones that are priced in lira get annual adjustments for inflation. They don't fully adjust for the real inflation rate, but they have catch-up provisions in the law after 5 years and 10 years. So when we look at the entire Reysas portfolio, in general, the rents they are collecting are significantly below market, but there are adjustments that take place every year which get them closer to market. And Turkey's inflation rate is coming down very fast. So
what's the Turkish inflation rate right now at the end of 2025? Turkish inflation rate for the past 5 years, 10 years, it went from 20% to 80%, back to 40, up to 70, and now it's back to 30%. Okay, so it's trending down, but still up a lot.
We may be in a position in 2 or 3 years where the inflation rate is single digit, maybe even mid-single digit, 5-7%. And in that environment, I think Reysas will not have such a big delta between market prices for their rents and the actual rent they're collecting. So in both cases, we don't see an issue with the currency or the governance. Moving on to metallurgical coal, you've highlighted Warrior and Alpha as amongst the lowest cost.
Interesting because I am a shareholder of AMR, Alpha Metallurgical Resources, and I've been a shareholder since 2023. So I think August 2023. So a little bit more than 2 years. So I'm deeply interested in everything that Mohnish Pabrai has to share with the world. Fun fact, in case you didn't know, Mohnish Pabrai has invested in metallurgical coal companies since May 2023. And the 13F was updated in August, and I bought it just after this. So we knew publicly that Mohnish Pabrai was invested in coal companies in August 2023. And just recently, we had a paper about the late Charlie Munger saying that he was also very interested in investing in met coal companies. So I strongly think that they had a dinner, Mohnish Pabrai and Charlie Munger. Charlie Munger talked about coal companies, and Mohnish Pabrai followed his mentor, followed Charlie, and just invested in coal mines. And after this, it's been 2 years? 2 years of due diligence, 2 years of Mohnish Pabrai going in the mines with workers, talking to employees, to the management team, visiting them wherever they are, and he has been very good in his analysis. Okay, this is what I can say. So yeah, I like to follow the coal thesis. Very few people, even on YouTube, very few people follow the metallurgical coal businesses, because that's not sexy, because that's cyclical, because nobody wants to touch this, frankly, because that's not ESG, because banks shy away from this kind of investments. And that is exactly the reason why Mohnish Pabrai invests in them.
Met coal producers, how confident are you that long-term supply is inelastic, given reports of significant expansion projects and greenfield capacity in the pipeline? So the metallurgical coal business and the various grades of metallurgical coal can lead to a confusing picture globally. What we are talking about is the highest quality seaborne met coal, which is priced off the Premier Lowball Index FOB Australia, Queensland. And that premium quality PLV coal is scarce in the crust of the earth, and it's only found in a few places. There are always possibilities of finds, new finds or new reserves, etc. But the development, mining, and transport of coal is very complicated. So even if there is a discovery of coal, the first question that comes up is how far is it from the port and what is the logistics to get it to the port? So for example, one of our holdings is a Mongolian Mining Corporation, and I visited Mongolia last year, and those reserves are phenomenal reserves. They are actually surface mined reserves, which is rare, very rare for met coal, but it's very far from a port. And the Chinese have reconfigured their supply chains to put a lot of their steel mills relatively close to the Mongolian border so they can take advantage of that met coal. But the transport, even with those mills being close by, is very complicated and very expensive. So we don't think you can find a mine or find reserves and then bring it to market in anything less than 5 or 10 years. And so we don't see a lot of change or increase in the global high-end production of met coal for quite some time. There are actually mines that are going away or mines that are long in the tooth. So we think the supply versus demand situation is very favorable on met coal. No guarantees, but I think from a risk-adjusted basis, it's a good probabilistic bet. And then how do you compare owning operators like HCC and AMR, where you take on operational risk, to royalty-style businesses like NRP that simply distribute free cash flow? Why choose the former over the latter? So when we look at the met coal space, and we looked at NRP in some detail, and in the end, we decided to take a pass for a few reasons. The first reason is it's a MLP structure, which requires it to distribute cash flows in the form of dividends. And in a mutual fund structure, we are not able to pass it through like we could in a private fund. So at the fund level, it would get taxed. MLPs have a little bit of inefficiency from our point of view on that, fund level taxation. When we look at AMR and Warrior, one of the big differences between the two companies is that AMR does not issue a dividend and is very focused singularly on buybacks there.
Fun fact, AMR had a dividend before, and the stock was so undervalued, maybe it was in 2023, that they said, we are stopping the dividend to allocate all our cash to do buybacks. So they had a dividend before, but the stock was so cheap and the management was so flexible that they just allocated everything towards buybacks.
Completely bought in on buybacks. Warrior has, because of their legacy of the bankruptcies, they have a lot of NOLs, and those NOLs may get affected if Warrior were to go very heavy on buybacks. So they've been burning through those NOLs, and it's also because of the NOLs that they are not able to allow anyone to own more than 5% of the stock. And we think in the next year or two, or maybe 3, Warrior will remove those restrictions because they would have burned through at least a lot of the federal NOLs. I think they still have a lot of state level NOLs. So Warrior has much better mines than Alpha, but Warrior has less efficiency on the capital allocation than Warrior because of its legacy. But if we look out 2, 3, 4 years, buybacks may become a big part of the Warrior story. They'll never be a big part of the NRP story because they have to distribute. And also the torque that we get from owning the miners directly is higher in a high-priced environment. So if we get to 250, 300, 350 PLV, the cash flows go totally bananas on the Warriors and Alphas of the world. They go up on the MLPs, but not quite at the same level. So these are some of the reasons why we prefer owning the miners, even though there is an operational issue that comes up. But it's a good question. Given Transocean, which is offshore oil services provider.
Yeah, this is what we saw here. Transocean. I'm not a fan at all about this investment, by the way. I have gone through it. Same thing for Valaris. Valaris, not a fan at all about everything here. Yeah, Transocean, Valaris. They had Noble before, and it seems like they sold Noble. Okay, fair enough.
Given Transocean's higher leverage and bankruptcy-free history versus peers that cleaned up their balance sheets through restructuring, what makes it your preferred way to play the offshore cycle? So one of the very important, the leverage that the offshore drillers have is a very important piece of the equation. That's one piece of the equation though. The second piece of the equation, which can maybe even dominate more than the first piece, is white space, which is when they have ships that or jackups, etc., that are not deployed. So a drill ship that comes off a contract and is waiting for the next contract is typically going to be fully crewed and almost have similar expense to what it had while it was under contract. So a drill ship might have a daily cost of $150,000 to $175,000 a day while it's on a contract. While it's sitting idle, it will still have a cost of more than 100,000, maybe 100 to 150,000 a day while it's sitting idle waiting for a contract. And so one of the adjustments I made when I looked at these companies is I looked at white space and leverage, kind of like two sides of the same coin. Because if I have a ship sitting idle that's costing 100,000 a day, I'm going to be bleeding about $35-40 million a year. If it's costing me 150,000, it might be 50-60 million a year for one ship. And that's significant, which means that, a working ship is almost offsetting what you're losing on an idle ship. Transocean looks very different from Noble and from Valaris from a white space point of view. In 2025, they have almost no white space, which is amazing compared to the other competitors. And in 2026, almost till the middle of the year, they have no white space. And if I look at their 2026 cash flows after, all the interest payments and everything else, if they did not sign a single additional contract, they would be generating somewhere around 500 million of free cash flow. The other two players, Valaris and Noble, have significant white space.
Wait, they mentioned $500 million in cash flow. What's the market cap of Transocean? The market cap is $4 billion. So price to free cash flow of 8, earn free cash flow yield of 12.5%. Yeah. Strange enough, I'm still not convinced by this company. I have to see a lot of things to be convinced, but the lack of profitability is something that doesn't sound right to me. Anyway, he knows better, right? So wish him well.
In 2025 and a significant amount of white space in 2026. So even though they have less debt, the white space comes in and crimps your cash flows. So when we stress tested all of these businesses against different scenarios, what we found, especially with Transocean, with the recent equity offering they did and debt offering they did, where they kind of raised about $1 billion, is we don't see any issue coming up for them in terms of their balance sheet and such, even in a very extreme nuclear winter scenario of almost no new contracts. And the other two players have a little bit more dependency on the new contracts. In the case of Noble, so first of all, we like all of them. I think they all have kind of a great business model. But Valaris and Noble kind of have some offset on the lack of debt with the white space. And another thing I would just like to point out about the white space. The reason there is white space, in my opinion, is because of one of three things. And it's probably a combination of all three things. Quality of the ships, quality and features of the ship is the first issue. Quality of the crew and operations, and business acumen in doing contracts. So I don't still understand the industry well enough to tell you that, what are the ratios of these three. But what I can tell you is that Transocean stands out versus the other two in terms of the lack of white space, which basically informs me that a combination of these three factors, it is superior to the other two players. And one of the advantages of not going through bankruptcy is the other two players were cut to the bone when they went through bankruptcy. They lost some of their best people, they lost some of their best talent. And Transocean went through some of that when Carl Icahn came in and pushed them to cut costs, etc., but nothing like what the other two went through in bankruptcy. So there's a little bit of a difference in how these companies look like because of their history on that front. And moving on, can you share any updates on Reysas, particularly around the capital raise and any operational or balance sheet development since the last call? Yeah, so every year I visit Istanbul and I sit down with Reysas management and I go through, kind of what's been the situation of the business and so on. I'm always impressed. So they are a very opportunistic player. They don't really have a strategic plan. They basically come into work every day and they look at what's the best they can do that day, and if there's nothing to do, they do nothing. So to give you kind of a recent deal they had done is that there was in Istanbul, availability of land for warehouses, a zone for warehouses is very scarce. It's very tight. That's why the warehouses are like 99% leased, and inflation index, even though the Turkish economy is not currently doing very well. So the government auctioned off a very large piece of land, which was zoned for warehouses. And Reysas was the winner of that auction for 2 billion lira, which is approximately $47 million or so. They just closed on that transaction earlier this week. And they already have like 4 different companies that want warehouses on that space. So they're going to begin construction, but it will not be spec construction. Probably going to have a lease in place with one or more players. They also might sell off some of the land because there are some smaller pieces there which don't fit for them. But basically, this is going to be 200 plus million of debt plus equity that goes in, 250 million of debt and equity that goes into building these warehouses out. And I don't think they'll hit it out of the park in terms of the returns, but they'll still produce very attractive returns on this bet and increase their footprint and become more dominant on the whole space. They've also recently entered Germany. They've formed a 100% owned German subsidiary called Reysas Deutsch. And anytime Reysas starts a new business or enters a new venture in a new area, they tend to start small and they want to kind of put their toe in the water and see how they go. So this is a very small bet where they're basically building 39 apartments and they have a joint venture partner, kind of 50-50 relationship. I think the economics are that they're putting in less than 4 million euros into this project. And when it's completed in the next year or 18 months, they'll have more than double their investment. And their plans are not to monetize and sell, but to become a landlord and basically rent these units out so that new co in Germany starts getting cash flows and they start looking at other deals, etc. So they've kind of planted a seed in Germany. It's their first real estate deal outside Turkey. And Germany is a very logical place for them to go because there's a lot of strong ties between Turkey and Germany. Basically, after World War II, as Germany was growing very rapidly and they had lost so many young people in the war, they basically had a big shortage of young people and they en masse brought in migrants from Turkey to help build the economy. And so there's a very significant Turkish population in Germany that's been there for 70 plus years, etc. So that's pretty good. With Gimat being a new position in your hedge funds, is it also something you plan on purchasing or have purchased for the mutual fund? Also, what's the thesis behind the company? So Gimat is I would say it's a very embryonic business. It's a relatively small company in Turkey. Easiest way to think about it is it kind of looks like Turkish Costco. They have 2 stores currently. They used to have only 1 store.
Gimat. This is the first time I hear about Gimat. Gimat. Wow, it's difficult to pronounce. Magazasilic. Oh my god. Okay, let me check. Gimat. Turkish company. Turkish Costco. This is the first time I hear about this company. Market cap of $150 million. So we are really, really small. Really small here. Okay, well, seems like revenue is skyrocketing. Maybe because of the devaluation, so all the numbers go up. Struggling to be profitable. No debt problem. Free cash flow is a mess. Really curious to see what he has to say.
A year ago, and the Wagons Fund owns a stake in Gimat, and I visited both the stores a few months back, and I visited with the leadership. Gimat is a very interesting business in the sense that it was started by 1,000 wholesalers coming together, each one basically owning 0.1% of a new co that they started a few years back. They had in mind that because they had so much expertise on almost the entire supply chain of supplying to retailers and grocers in Turkey, that they could basically create a store which was kind of a pseudo wholesale store in a very large footprint kind of situation like a Costco. There isn't much of that in Turkey. In fact, I think they're very unique in what they did. And the price points at which they're operating and the margins at which they're operating have made these first 2 stores incredible successes. In fact, normally when a retailer is opening a new store, it might take 2 or 3 years for the sales to ramp up because it's new and people have yet to hear about it and so on. But when they opened their second store, the sales instantly did a step function. They took off in a major way, simply because the kind of value you get and the selections you get and the environment in which you shop is very attractive and very favorable. So I think that it's almost like a venture investment, even though I don't think it's like a venture investment from the point of view that the risk profile is very low. So we feel that if the company has aspirations to have 80 or more stores in Turkey, they also have aspirations to maybe have stores at some point in Germany. I told you there's a huge population of Turks in Germany. And
if you follow the Costco route of international expansion, you also have to mention that Costco has failed many times to go abroad.
Don't know whether they will be able to pull it off.
You want a fun fact about Costco? They tried to go into China and they failed because of bribery. And then a few years after this, they tried to go into China again and failed again because of bribery. Too strong. And then they went there a third time, and it worked out okay. And now Costco is fully booked out. The queues are amazing over there, and it works out fine. But depending on the culture of the country, maybe some businesses won't be a good match. So I don't know about Gimat. I will not invest in this company. Too niche.
Or not. When I look at the DNA of the company, and I look at the management of the company, and I look at the culture of the business, I see a lot of resemblance to Costco. And I see a company that is more likely than not to make it. But early stage businesses like this, with 2 stores, I mean, I would be able to give you a better read if it was 10 stores or 20 stores and I had more trademarks to look at. So we made the bet relatively early because we like the situation. It's also a reluctant public company. They did not want to go public. The Istanbul Stock Exchange tapped them on the shoulder a few years back and said, hello, you have more than 600 shareholders. And if you have more than 600 shareholders, you are deemed a public company. And you have to list the company on the stock exchange. So they were forced to list the company on the stock exchange. Pabrai funds, my private funds and Wagons Fund and some other entities that I control collectively own now more than 20% of Gimat. We are the largest shareholder in Gimat.
Oh my God.
I mean, I think of it as a possible compounder. I mean, if they do actually execute on their plans, it would be an incredible home run. But there are a lot of things they have to do to make that happen. It's not easy. So we'll see how that goes. But
yeah, I mean, that's a potential compounder for you watching this video. Who knows Gimat? Frankly, who knows the Gimat? If Mohnish Pabrai says it's a potential compounder, maybe you want to spend a few minutes about the company. And if you are Turkish, of course it will help.
We like everything that we've seen so far. For offshore drillers generally, how do you estimate replacement cost and think about how today's day rates and utilizations would have to evolve for the stocks to approach that value? Well, the estimation of replacement cost is fairly straightforward. I mean, if you talk to the various insiders at these businesses or analysts, etc., a drill ship, like a 8th-gen drill ship that one might want to order, is unlikely to be available for less than $1 billion. It's also unlikely to be produced in less than 5 years. In fact, a lot of the expertise for building drill ships is gone. People have left the industry because the industry has been in a nuclear winter. There hasn't been a drill ship built in like almost a decade. And so there's a lot of things that would need to have to come together. Also, the shipyards, they're booked solid, and they aren't going to be willing to take an order for a drill ship without a very large deposit, something like a 50% deposit. So there are industry insiders who believe that the last drill ship to be built for humans has already been built. And there are others who believe that there are possibilities that a national oil company or someone like that could build a drill ship. Basically, in order for one of these offshore drillers to justify placing an order for a drill ship, you would have to be approaching 100% industry utilization of the existing ships. You would have them having a contract for 10 or 20 years, approaching $1 million a day for these ships before they would be willing to put up the capital to do something like this. So from our point of view, the way I look at it is that the fleet that exists is the fleet that exists. If there's a drill ship being built, all the rates for everyone is going to go up before that ship gets delivered. So it's not really, the replacement cost is not relevant to us when we're doing valuations. It's a relevant data point to tell us about the kind of size of the fleet and how much more capacity might come on and that sort of things. Bottom line here with these businesses is that the current daily rates do not justify the building of any of these ships. All the rates would have to more than double, 2 to 2.5 times the present rates for any justification of these ships. And there are some cold stack ships that would need to come back first. So our take on the industry is that the capacity utilization is, depending on how you look at it, approaching 90%. As you start pushing 90, 95% utilization, upward pressure on rates becomes real. And then there's a lot of torque where even if rates go up 10, 20, 30%, the cash flows of these businesses might be going up more than 100, 200% because they would have no white space and they would be, every ship coming off is being put out at 50% more than the previous rate and so on. So again, none of these are kind of guaranteed, but we like the risk reward of these situations here. And so that's why we have a bet here.
I would like to make a comment here. This situation in the offshore drilling department is quite similar to the situation we are seeing in metallurgical coal companies, which means nobody can predict the future, especially in the short term. These industries are cyclical. They rely on other people. For coal mines, they depend on the coal prices, steel prices, obviously Australia, obviously China. They depend on logistics. If you are a shareholder, you probably know this, but a few quarters ago, a bridge in Baltimore fell down, fell off, collapsed. And this was a main route for Consol Energy at the time. Who remembers Consol Energy? They merged into another company. Anyway. And this was a logistics issue that impacted the business. You have many things, many variables, many moving parts for these companies. But if the situation is bad, coal mines are at break-even and not losing money. And if the situation is good, coal mines are printing money. So you don't have an equal situation. If something is bad, you lose, $1 billion. And if the situation is good, you win, you earn $1 billion. It's not 1 billion, 1 billion. No. It's either you're flat or either you earn $1 billion. So in terms of risk reward, best case scenario, you have $1 billion. Worst case scenario, you're flat at break even. So in terms of risk reward, it's the perfect quote from Mohnish Pabrai: heads, I win; tails, I don't lose much. And offshore drilling companies are exactly in the same situation. So yeah, I understand his reasoning behind these investments because that's his philosophy after all.
Do you weigh the risk that easier financing for met coal versus thermal coal could cap prices over the long term, similar to how shale capped oil? Well, so in order for capacity increases to happen in metallurgical coal, there's a number of stumbling blocks. First stumbling block is that there is no equity capital available and there is no debt capital available for anything that has coal in the name. So
which means nobody wants to partner up with these companies. JP Morgan has a famous story about cutting their relationships with coal companies. Literally, JP Morgan, the biggest bank, the best bank on earth, saying, no, if you have coal in your name, I want nothing to do with you anymore. Sorry, but ESG is ESG. This is the world we live in.
Banks and equity players and so on don't distinguish between thermal coal or met coal or any other coal. They want nothing to do with coal. So first of all, it's very difficult to raise the capital, debt or equity. The second is that not in my backyard. So to get a permit to get a mine going, so even if you find reserves or find a thick seam somewhere, going through the process of actually getting permitted and deals to be able to extract that coal is a difficult situation. The third thing is that the transport. So if this thing is not near a port and depending on the country and the different logistics, that's another stumbling block. Even when you remove all the stumbling blocks, you're looking at 5 to 10 years from the time a reserve is identified to the point that something is shipping into the market. And so there's a very long gestation period here. And so we just don't see a huge increase in supply coming on suddenly for quite some time, if ever. Moving on to, we have some bets on home builders. With high home prices, reduced affordability, and elevated...
By the way, guys, let me add some value to thank you for clicking on my video. You know I'm a shareholder of AMR. I told you at the beginning of the video. It's a company in the metallurgical coal space. I've been a shareholder since August 2023. I've been following the business closely. And now the stock bottomed and it's already a double in 6 months. I am following a couple of accounts on Twitter that know this industry quite well. And I'm also monitoring all the earnings reports, all the earnings calls for AMR. I don't make a lot of YouTube videos on this topic because that's very niche and that's not a core holding in my portfolio. But I'm still following the story, as I do for many stocks actually. And it seems like if this is a turnaround play, the stock has already turned around. The latest earnings report was pretty good. They increased their guidance for revenue and they decreased their guidance for costs. So you have a gap between more revenue, less costs, which means profitability. At the same time, they said that we've been stopping the buybacks for a few quarters, but we think now is a good time to start again. So here we go. Look at the buybacks in 2022, 2023, buybacks every quarter. And they stopped to keep their cash and be safe because of a cyclicality and things go down, profitability goes down. And we start again. You have two signs of potentially a bottom. If we are bottoming out, this quarterly report was the bottom. They start the buyback again. They increase the guidance for profitability. They still have zero debt. They are filled with cash. They can do many buybacks, more buybacks, and the stock is very cheap. And it seems like for the day of the report, the stock was up immensely, like $160. And I remember we talked about this inside my coaching program, saying, guys, if you want a value play, this could be really interesting here. And it seems like the company is operating well so far. Looking forward to the next report, actually. And people are expecting a bottom in this situation, which means the stock is going up back to 200. Some people took advantage of this. You don't need to be invested in tech to make money in the stock market. You can just follow some cyclical plays. Yes, it's tricky. Yes, it's volatile, but sometimes it works. So maybe this is bottoming out. And I don't think we are the top 300. If we are at the beginning stage of a new cycle, this stock can go to 300, 400, or even more than this if you add buybacks to this. But again, you have many moving parts, right? It depends on the price of coal. You can check this chart, the API2, but now it is getting technical. You didn't click on this video to learn about this, but anyway, let me give it to you so you have more value. You can check this. This is the price of coal that major metallurgical coal companies are following. And you can see that in 2022, 2023, it was really high. So because you work with fixed contracts, you sell a lot of volume at a very high price. This is the reason why AMR printed money in 2022, 2023. Now this price is down, but it seems like it's stable now. So it's just about managing your costs. If you can manage your cost at 100 for the coal price, you can be profitable again. After all, this is not a bad plateau to be in. We are at the highest level compared to the past 10 years. So it's a very high plateau. You can make money. You can be profitable. And what if inflation in this industry picks up again? What if inflation goes back up? What if this price, the API2 prices, go up again? It's a scenario that is possible. If this is going up, AMR will print money again. And if AMR prints money again, they will do a massive buybacks. Look at this. In 2022, they bought back 15% of their shares. In 2023, they bought back 16% of their shares. They can do it again. And look at what happened during their stock prices. Stock prices doubled, tripled. It can happen again. So I'm a shareholder, full disclosure, so I have to monitor this. Anyway.
Mortgage rates leading to cautious 2026 revenue guidance from builders. What
Homebuilders.
is your long-term thesis for this group? So the home builders we have bets in the portfolio. We have two bets with Toll Brothers and Pulte. They are amongst the lowest conviction bets we have, even though we like them. Basically, home builders have a few things going for them on a kind of, you take a step back. First of all, the housing stock in the US is basically short by several million homes.
Yes.
Depending on who you ask, 5 to 7 to 10 million homes. And homes that exist, the stock is getting old and dated. So we need to be building about 1.5 million or more homes every year, which is not happening, which means that gap is extending. Now, in order for those homes to get built and bought, we need a robust economy. We need low interest rates. We need people doing well. We need young people kind of moving out of their parents' homes and all of that. And there we have challenges where, the economy and affordability and the mortgage rates and all that. So there are headwinds which are in place currently. But one of the tailwinds that is going on with the national home builders is the national home builders have a secular advantage versus the mom and pops. It has become a very manufacturing oriented industry. They're able to have a significant cost advantage versus the smaller players. So they have a margin advantage versus the smaller players. And there's a few national players. So basically the consolidation of the industry is giving more power and more margin to the best and largest players, which is a secular trend that's continuing. So that trend And at some point, we may see interest rates lower and the pressure of not having enough homes and all of that. We think it works well. And I think the second change that has happened in the industry is the large players have become capital light. So it took them about 2 decades to learn from the NVR model, but they're all moving towards that model. They're not holding large banks, land banks.
Okay, this is great. And I've seen this also. NVR, if you don't know this company, it's a company that went bankrupt in the early 90s. And they came out of bankruptcy saying never again. So instead of being capital intensive as a home builder and owning large parts of lands to then build homes, they used options. Options, if you have a buyer for a house, you exercise your option, you buy the land, which means instead of being a landlord and having a lot of lands, you can just be very selective and not incur many costs. And all the players like Toll Brothers, Pult Homes they have not done this for years and years and years. So they were capital intensive. But over the past couple of years, this model has shifted. And more players are using options to just buy the land in case you have a buyer of a house. Okay? And I see this pattern happening for many players in the home building industry. You have a few of them in the south of the US. You have a few of them in Ireland and in the UK. Okay? That's pretty good. By the way, you know what? I know this video won't get a lot of views, so let me just share some value to thank you. You have a company in Ireland that is called, what's the name of the company? Glenveagh Property. I have a doubt for the name. Glenveagh Homes Properties, Guru Focus. Glenveagh Properties. I don't even know how to pronounce this name. It's a company in Ireland. They follow this asset-light business model. Nobody knows this company. This is why I love my job. Market cap of $1 billion. Home builder, they do a little bit of manufacturing. And in Ireland, similarly to the US, you have a deficit of homes. Too few homes. So you need to build. And they are building. They are growing revenue nicely with profitability. And they are doing massive buybacks. In 2021, they repurchased 11% of their shares. In 2022, this company repurchased 17% of their shares. It was 2022. In 2023, they repurchased 9% of their shares. In 2024, 3% of their shares. And look at this. The ROIC, return on invested capital, is growing every year. So you are talking about a niche player. Nobody is invested in Ireland. So nobody knows this company. They generate profits. They use cash flows to repurchase shares. PE ratio of 9. Nobody knows this. And now you can add Glenveagh Properties to your watch list. Fun fact, I talked to the management team when I was working in Paris in an investment fund. This is how I discovered this business. So this is lovely, and I've been following the story since then. And I've talked to the management team. They are pretty hardcore fans of the NVR model. You do whatever you want with this information, but I think you have enough information to start the research now. Let me continue.
Banks, they're holding options on land and just-in-time purchasing and all of that. So they are very cash generative. Multiples are relatively low, so they can engage in buybacks and so on. And so we like the governance, and we like the way these businesses are run, and we like the long-term tailwinds they have. So that is why we have them in the portfolio. For Occidental, how do you view the OxyChem Berkshire deal and what it implies for Occidental's long-term economics and capital allocation? Our Oxy bet is, again, one of our lowest conviction bets, probably even lower than the Homebuilders, but I still like the bet. And the OxyChem deal that Berkshire did is a very good one for Oxy, and I took it because it takes their leverage down. They had pressure on their balance sheet, and this has given them heavy breathing room, which is excellent. I think the Oxy thesis eventually is likely to be one or two factors that drive it. So one is, if we get bump in oil prices at some point, Oxy is a big beneficiary of that. And the second is that if there is further innovation on fracking, which brings down the cost. And Oxy is already one of the lowest cost operators, but if they're able to kind of pull one more rabbit out of the hat, I mean, fracking has already pulled many rabbits out of the hat. Charlie used to say that it's not a zero probability that they could put one or two more rabbits out of the hat. And so there are some upside scenarios with Oxy on that front with a very relatively muted downside. And so that's why we have that bet. Moving to general question is, how do you reconcile your circle the wagons philosophy of a few high conviction bets with mutual fund constraints on maximum position sizes and ownership limits? So very good question. In our private funds, for example, we don't have these constraints of diversification, et cetera, being dictated to us. What I might do in an industry like coal, I might have all of it in one or two bets, highest conviction ideas. When we move to the mutual fund, it might be top four. And so if I were looking at the home builders and I had full discretion, I would just pick one. But because I need to diversify, we end up with two or three, and the same with the car dealerships, etc. We end up with multiple. But we don't think that's a big penalty we're playing. There's not that much of a delta. We're okay with that. Could you walk through an example of a business you seriously considered but ultimately rejected, and what specifically made you say no? Yeah, so a couple of
It's a great question. Maybe the first time I see this question publicly asked. I've been following Mohnish Pabrai for more than 10 years. I watch all his videos, all his interviews. This is a very good question.
Examples, maybe I'll go through one example just in the interest of time, is when we were looking at the car dealerships. We did a lot of calls and we did a lot of site visits to the major players and different locations. And we thought the highest quality business in the car dealership business was Penske Automotive. And with Penske, they have an amazing truck business, which is headquartered in Dallas. We visited and spent a whole day with them, which is fantastic, incredible. They also have truck leasing services business, which is based in Pennsylvania. We also visited that business, spent a day in Pennsylvania, and that's another incredible business. And then when we visited different Penske dealerships, for example, in Austin, there are two Lexus dealerships. Lexus particularly has very tight restriction that no single owner can own more than 8 Lexus dealerships in the country. Penske owns both of them in Austin. And when we visited those Lexus dealerships that Penske owned, which is a total monopoly, you would have to drive 150 miles or something to find another Lexus dealer from Austin. They were run in a world-class manner, very good people. All the people we met at Penske blew us away. They were the highest quality people. And then we also visited BMW of Austin, which is also owned by Penske. So Penske, I met Roger Penske briefly at the memorial service for Sergio Marchionne in Detroit a few years back. He was sitting right behind me. And now, of course, we've seen Roger in the NASCAR series. So Roger is the real deal. He's a exceptional businessman. He's a high quality operator, and he does not want to have anything to do with businesses that don't have the highest quality. So we like Penske a lot. I think it was great. Now, the issue was that Penske was trading at 50 to 70% premium in price to the other car dealers. And the other car dealers were not slouches. So we visited Ashbury, Group 1, Lithia, AutoNation, so on. We definitely think Penske was higher quality. But when you're doing buybacks at 18 times cash flow versus 8 times cash flow, that makes a big difference. And so that was an example of a business where we spent a lot of time, but in the end, we decided that risk-reward basis, some of the other players were better investments.
So basically, the best business he found in this industry of car dealership was Penske, but the price was too high. Okay, so it's about risk reward. And you have other alternatives like AutoNation, Lithia Motors, Group 1 Automotive that are almost as good, but at a cheaper price. Asbury is pretty good. Asbury, I like it a lot. AutoNation also, AutoNation is famous for buying their own stocks. So, major buyback player. Lithia Motors is very good, growing more than the rest, and they have a little bit more debt, I think. Okay.
Are you willing to hold Edelweiss and its demerged IPO businesses? And what would make you shorten or lengthen that time horizon? Yeah, so I think we might have answered this question earlier, but basically a lot of the businesses that they have of long-term tailwinds, good businesses, capital light, high returns on equity and high growth. So if the businesses are doing well, they've got good management, etc., we would like to keep those businesses. India has a lot of tailwinds in financial services for quite a while. We have about 11 minutes left, and I've gone through about 14 questions, so we'll keep going and see how deep we can get on the list.
Yeah, by the way, if you want to invest in India, please check what Mohnish Pabrai's daughter has to say. Okay? She made a podcast quite recently, a few months old, and she is talking about Indian investments, stock exchanges in India. Okay, so that's a good potential investment if you want to look into India to see what his daughter has to say.
Warrior has a very strong outlook and a new long wall coming online, yet it's only the number 3 position, roughly half Edelweiss's weight. Why isn't Warrior larger if you still see potential for a 10x outcome? So the Warrior position is not half of Edelweiss. I think it's, if I look at it currently, in fact, today was the first day Wagons Fund went over 100 million in assets. So we were very excited about that. But if you look at, and all the met coal names went up a lot today. But if you look at Warrior, it might be like maybe 30%, 30 or 35% less than Edelweiss. It's not that much. I think it's a 13 to 15% position, and Edelweiss is like 18, 19%. And so we're both big bets. And I've already pointed out that Edelweiss itself is very undervalued. And I think we would have a healthy debate internally if we would try to figure out which one is going to do better. And they both have a lot of torque. For Alpha Metallurgical Resources, how do you get comfortable with the path to 700 million in sustainable profits given current volumes and pricing? What needs to change to get there? So,
great question. I want to see the answer now.
The Warrior bet is a very simple bet. If you have a business that you can buy for 2 billion, that business will be around for 50 years and then disappear. And in the next 50 years, the cash flows it will generate may range from 0 to 100 million a year, all the way up to maybe 2 or 3 billion a year. So
this is exactly my point. The market cap is $200 billion. And the cash flows are between 0 in a bad year and $1 billion in a good year. Look at this. I mean, let me show proof of what I say. This is your cash flow. Now we are in a downturn, right? And they are not, I mean, you can look at the past if you want. Now we are in a downturn. They don't produce much cash flow, near 0. In 2020, 0 free cash flow. You know, they don't lose $1 billion when the time is bad. But when the time is good, they produced more than $1 billion in free cash flow. Or in 2023, when the cycle was less hot, $600 million of free cash flow. Okay? So, worst case scenario, you are at break even and you don't produce any free cash flow. That's 0. Best case scenario, you produce $1 billion of free cash flow. And the market cap is $2 billion. It's stupidly simple. You can just stop the analysis here if you want. And I mean, let's see what he has to say.
Have a business that you can buy for 2 billion. That business will be around for 50 years and then disappear. And in the next 50 years, the cash flows it will generate may range from 0 to 100 million a year, all the way up to maybe 2 or 3 billion a year. So if that is the range of cash flows, maybe 100, 200 million on the low end and, 500 billion, billion and a half or 2 billion or more at the high end, and you got 50 years of this and you discount it, where do I sign? And so when you talk about a 700 million profit for Alpha, the very simple math is they produce 15 million tons. If I wanted 150 million in profit, they need to make $10 a ton after tax. And if they make like 40 or $50 a ton, they would be making the 700 million. So you look at the 40, 50 million per ton, and then you look at their cost structure. The cost structure has some variance with the price. So their current cost structure is about $135 a ton. If the PLV is at over 200 now and they're getting a $30, $40 margin, that's a good business. But if you get to 250 a ton, 300 a ton, the cash flow goes bananas. So I think it's not very hard for a business like Alpha to produce 5 or 600 million in cash flow. 5 or 600 million in cash flow is only about $30, $40 a ton. And their chief operating officer, Jason, who I think is a total rock star, he's probably one of the best 2 met coal miners in the United States. And Jason can squeeze blood out of a rock. And he has dropped AMR's cost very significantly in 2025. Really surprised us that he was actually able to drop the cost as much as he did. So they've moved further back on the cost curve. They're still more expensive, much more expensive than Warrior. But they're in a very good position to make very good profits at a PLV of 200 to 250. And PLV 200 to 250 does not require heroic assumptions.
They reduced guidance for costs, so they continue to be more efficient.
Moving on to roughly how much of the current portfolio is cloned from other investors versus original ideas which investors have most influenced specific current position and which investors have influenced most? Well, they've come from all over the place. But I would say that, as you know, that I am the
That's not a good question. Mohnish Pabrai is known for being a shameless cloner. Why do you want him to not clone? He has built his whole life cloning the best practices from the best investors. What do you want to ask if how much of the companies are cloned and initial ideas? I mean, the best case scenario is everything is cloned.
shameless cloner. And I would say that, as you know, that I am the shameless cloner. And I would say all our Turkey positions are cloned. One of the things
by his friend, and he visited all their Turkish investments with the same friend. And if you want to know this, please follow Mohnish Pabrai on Twitter. Same thing with his daughter. You can see what they have to share on Twitter, on X, and the fact that they have been visiting Turkey a lot recently, visiting specific companies. Okay, so you can know this.
about the interesting thing about cloning is that our original interest in coal came from Consol Energy being bought by David Einhorn and it being his second largest position. And that sent me down the rabbit hole of coal. And when we went down the rabbit hole of coal and we studied everything in coal, we ended up basically moving away from Consol and ending up with, Alpha and Warrior, etc.
Yeah, Consol and Alpha Metallurgical Resources are pretty similar. They just use all their cash to pay off their debt. And what is remaining of cash flows has been used to do buybacks. So the graphs looks the same. You print cash in 2022, 2023, you use all this cash to repay your debt, to have a clean balance sheet, and you use the next year of cash flow to do buybacks. And they have been a merger of Consol Energy. So now it's a little bit different. And AMR is a pure met coal play. David Einhorn has been investing in Consol Energy for many years now. That's, I believe, his second largest position. Can I check on Data Roma? You should have Green Brick Partners or Consol Energy. Yeah, now because of the merger, it will be different. A different ticker. It's CNR. Yes, it's Core Natural Resources because now Consol Energy has merged with another company. And yep, you have Green Brick Partners, so Homebuilder in the US, 27% of his portfolio, and Core Natural Resources, which is what Mohnish Pabrai says, Consol Energy, this is the same, 7% of his portfolio. In the past, it was his second largest position, but apparently David Einhorn just added to this Fluor position, another value investment. Okay, and you can check David Einhorn first bought into Consol Energy in 2017. You can check his letters. This is free and publicly available online. If you're curious and if you want to do the work, everything is free. Everything is free for public letters like this. Some letters are private and you have to pay, but for David Einhorn, this is free. So you can do the research if you want.
So Alpha, Warrior, Mongolian Mining,
I'm surprised he didn't talk about Charlie Munger.
coal, we ended up basically moving away from Consol and ending up with, Alpha and Warrior, etc. So Alpha, Warrior, Mongolian Mining, etc. are not cloned positions, but they came from original interest in a coal position that we cloned. And similarly, I think that the drillers, we were interested in Valaris coming from Kapi.
I don't know if I can find this, but there is an article that was written recently about Charlie Munger, and the article mentioned Consol Energy and AMR. So Charlie Munger was invested in Consol Energy and AMR. I don't know how I can find this. You have to go through a paywall. It's a Barron's piece It's a Barron's article, if you want to check, about the late Charlie Munger. So quite surprising.
From original interest in a coal position that we cloned. And similarly, I think that the drillers, we were interested in Valaris coming from Cuppy, but then, we broadened the horizon. Now we have bets that are not Cuppy bets. So I think that the home builders have also come from looking at other investors I admire. The auto dealerships, I think I can't point to who I was looking at, but I've seen it in portfolios. Oh yeah, actually, I remember who we got the auto dealers from, but that was another cloned position. I don't think there's a whole lot. We've owned Edelweiss for a long time, and I think the first time we invested in Edelweiss, the first time I met them, might have been more than 10 years ago. And that may not be a cloned position. I'm not sure of the history there. I have to think about it. But yeah, most of it is cloned. So that's just the way it is. But it's a good question. When you compare Transocean's replacement value and enterprise value to those of Valaris and Noble, how do you think of margin of safety and upside? And I think we addressed some of it, but the replacement value is not where we fixate on. Any business is going to be worth the sum of future cash flows from now till judgment day, discounted back at a reasonable interest rate. So nowhere in that equation is anything about replacement value. So we are not going to these businesses will not trade at replacement value, for example. That's not a metric we focus on. But when we look at the cash flows coming out and the quality of the businesses and the assets that they have and all of that relative to the market caps, I think it looks extremely favorable. I think you would almost do very well throwing darts in this space and making bets. I think you'd be quite well doing that. One more question is, how does Warrior's Blue Creek mine coming online earlier than expected impact global supply? Well, Warrior is we're already seeing high wall A, which is what is being produced at Blue Creek, etc. Normally, high wall A is at a 5 to 10% or 8 to 10% discount to the PLV index. That discount is approaching like 15-20% currently. But the way I look at it is that the bigger issue is where's the PLV at? And the second big issue is where's the Warrior cost curve at? So Warrior has come in at a cost curve that was lower than what they had predicted. We are seeing some discount with the high wall A. But I don't think it can go too far off because the smelters, the people who are running the mills, will start altering their mix of coal that they use if they can get a better deal on one coal versus another. They cannot change the chemistry a whole lot, but they do have some leeway on that front to adjust things. So we are at 4 o'clock. I'm sorry I couldn't get to everything.
Okay, before you leave, guys, I want to share something with you. I want to copy the link from my phone. I was looking for the article of Charlie Munger. It's not Barron's, it's Wall Street Journal. And I can open this up. No, and I can click on this. Normally it should work. Please airdrop work properly. Here we go. You have the untold story of Charlie Munger's final years. Article that was released a couple of weeks ago about the last years of Charlie Munger. And in this article, they mention that he invested in 2023 in the coal miner Consol Energy. Later in the year, he bought shares of AMR, Alpha Metallurgical Resources. Funny, right? The same quarter Charlie Munger is buying shares, Mohnish Pabrai was buying shares. So I'm surprised he did not mention Charlie Munger. Anyway, he may be cloned partly from David Einhorn and partly from Charlie Munger. Maybe Mohnish Pabrai had been studying David Einhorn for years, and then Charlie Munger inspired him to take a position, like it was a little push that gave him conviction. Anyway, Charlie Munger was buying coal miners. So Consol Energy and AMR produce steel, coal for steel production, and fair enough. Okay. They're dropped. Very good. So yeah, let me add some value in this video by saying, Charlie Munger was the shareholder of this.
But we tried to get to as much as we could. And thanks for joining us. And I wish you all the best. And I'll see you in a few months. Bye.
Okay, fair enough. Thank you for watching my video, guys. I see you tomorrow. I hope you learned one thing or two during this Mohnish Pabrai interview. And I see you tomorrow. Bye-bye. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.